Here is how I'm preparing my 100% CoveredCall ETF portfolio heading into 2025. I've made some adjustments. I don't make many, I must say. I've actually counted out recently the kinds of transactions I've made, buys versus sells, or since the beginning of 2023, and it was like something like 350 buys to say 27 sells. So I buy. Very rarely sell unless there is some sort of significant change. New information's come in that helps me kind of understand my own strategy just a little bit better. And that's what's going on here. So I want to talk about some new funds I've picked up, even some old funds I've picked up, and exactly what my future non-registered account is going to look like, because this whole exercise has really, I would say, made it all of that very clear, especially if you've followed this channel for a while. Now, there's one video in particular I made that has probably had the biggest impact on me, and it was this one here, which, I mean, on the surface doesn't exactly look like the biggest banger of a video, but income yield versus income growth, where I kind of broke down the positives and negatives about more or less getting your distribution from a higher yield versus getting more of your total return through the capital appreciation. Now, I lean more into that camp. I would say is, how do I get the maximum yield with the maximum price appreciation with diversified funds? You can certainly get a higher yield and higher appreciation the more concentrated down you go, single stock, ETFs, etc., etc. So one of the things I talked about in this video right here was the fact that if you are an income growth investor, right, you put more of your return is coming through price appreciation. The biggest detractor is the fact that as an income investor, it might come across as a bit annoying that those unrealized gains are not working for you to gain extra income. So that's quite the quagmire, and that has influenced me to make some changes. So I'll give you some examples. Well, I should say, prior to making this video, there were two funds in my portfolio that I identified as being that had probably racked up significant capital gains, unrealized capital gains, that is. And I felt like I needed to make an adjustment to get more of my return, at least through one of those funds, more or less through the distribution. As an income investor, that ultimately is what's more critical versus just the unrealized gains racking up forever and ever and ever. So I wanted to show you all kind of what that all sort of looks like. So let's head into Passiv, which is, again, great free portfolio organizational tool. It basically tells you what to buy, right? If you can set targets, and basically it'll just tell you, if you want to hit those targets, percentages, it'll tell you exactly what to buy. It'll never tell you what to sell. That's all on you. But as for me, who dollar cost averages, that's great. Easy math, keep things equal or at least close to those percentages. One thing you're going to notice right away, because I've done a lot of overview videos of my portfolio. The spousal RSP has always been there. The TFSA has always been there. I've added another account. I've added an RRSP. Okay, so we'll get to that in just a minute here. So the first fund I wanted to discuss that has racked up significant capital gains, and I will show you the numbers in a little bit here, which is the spousal RSP. Again, I've identified this fund as this has been just a killer fund. It's, again, racked up a lot of capital gains. This is a short-term play, though, meaning I'm going to dissolve this entire account probably within the next, starting, I would say, in about 2 years from now. There is, for many of you guys know, I set up the spousal account under my wife's name. We contributed to it for a couple years, and then I've stopped contributing to it as of August in 2023. I got to wait until at least August of 2026 before I can take that money out, where it will no longer apply to my income tax level. It'll apply to my wife's income tax level, and she doesn't actually earn an income. So that benefits us that way, that we get that money back at a much lower tax rate. And basically what we're going to do with that money is put it into a non-registered account to help out offset the cost of a house rental. Talked about that at length. I'm not going to talk about that all that much in this video. For me, HYLD.U stays. I really have no hunger for any other American funds. I'm just going to let this ride out. It can gain capital gains all it wants for the next couple of years, and then I'll start chipping away at it, maybe in 2 different withdrawals, maybe one at the end of 2026, one early 2027, just to minimize the impact of that of taxes that are going to count against essentially her income. HYLD.U stays. Now the TFSA, a much more interesting account. It's not just one fund. What you're going to notice right away is I don't have HTAE anymore. This was another fund that I identified as something that had racked up significant capital gains as opposed to all these other funds. Now the one thing with HTAE, it's a pure tech fund, which means on the price appreciation side, it has done very well in the past year since I picked it up in October 2023. I think my total return was above 30%. Price return was in probably the 20%-ish range, like low 20s, 20, 21. So I had about $5,000 of unrealized gains that was doing nothing. And so I kind of sat on that because I actually really like HTAE. Now, we're not supposed to like investments, not supposed to apply emotions to certain funds or stocks. We're not supposed to, but I think in the end, we're all going to have our favorite funds or stocks or certain funds that we just really like that has really helped us out. So HTA was one of those funds, had significant capital gains. And the other thing I wanted to do was with a fund like that, how could I offset that mix of receiving a much higher dose of unrealized capital gains versus the yield? Now the yield for me, yield on cost, was maybe around 12.5% thereabouts. But the imbalance was quite different. Much higher capital gains and the yield was a lot smaller. Albeit for me, if it's above 10%, I love it. Absolutely love it. So I wanted a fund that could kind of bring that back into balance, a much higher yield, get more of my return through the distribution with a potential for lower price return. And I'm looking around thinking what other kind of fund might give me that. And I landed on QQQY by Evolve, which I actually haven't invested in any Evolve products before, but here we are. So I looked at Evolve, I looked at the kind of yield it had, I looked at the kind of stocks it held within inside of it. For me, this seemed like a no-brainer. It's basically the HTA adjacent, but you're getting a little bit more of your return through the distribution versus the price appreciation. So I was able to, I swapped the two out. Not only am I getting a higher yield, a similar fund, I also get to invest in a different fund manager that I hadn't invested in before. So QQQY really was not on my radar up until the last few weeks. Not only that, but with the sale of HTAE, those capital gains become realized and now I get to put them to work. Now, I didn't just get to put them to work in the TFSA here. As you can see, I got to build up that 20% allocation backup for QQQY. I didn't want to totally abandon HTAE. Like I said, I like the fund a lot. And so getting rid of it, again, was just more of a strategic move, but I just couldn't let go of it completely. So what I decided to do was I set up a personal RSP, something I've actually never done for myself, which set up a personal RSP because the spousal RSP is for my wife. And I was able to contribute about $9,550. Because I contribute to a pension, It offsets my limit for RSPs. And so obviously I'm going to be able to get a bit of a tax break by doing this. Now, one of the reasons I didn't think I would want to set up a personal RSP was because I figured I would want to put absolutely maximum dollars to work that are flexible, and I could just grab basically at will through a TFSA or say a non-registered account for various expenses, whatever might come my way, and maybe eventually start getting, contribute to an RSP. But what I realized was my TFSA, as next year comes and I sell my home and put that money to work to offset the cost of a rental, the TFSA was always going to be meant to be something that shouldn't help out in that regard. It's just meant to be something that continually reinvests, but I could use it for other investment purposes, which I actually decided to use in this case. So for me, the TFSA is going to be kind of the all-weather approach. It's going to fund other accounts. Yes, I'll max it out as best I can every single year. But in this case, I actually drew from it. Not a bad time of year to do that because we're right at the tail end. So yes, I lose $9,550 a space, but I get that back January 1st. Now I've actually done this move before, selling some stuff off to cover some costs in like 2021, heading into 2022. And I got the room back right away. So not a bad time to think about if there are some moves that you want to make to do so, because honestly, I can wait 30 days, get all that room back, and start maxing it out again. Took that money out of the TFSA, put it into the RSP. Again, I'm expecting similar deduction space coming in 2025, maybe something around $9,000, $8,000, somewhere around there. Again, it's because a pension kind of offsets my contributions as I've been part of a union since I was about 20 years old. So that really helped sort of secure the idea that, not a bad idea, just fund the RSP. You're not going to touch this fund for a while. So at least in this account, it actually makes more sense. Have HTA in there, let it ride as best it can. Maybe it might not be because at the end of the day, yes, total return is the best way to look at these kinds of funds. But in my case, I'm actually okay keeping just HTA in here. I think if we do see a downturn, this fund will go pedal to the metal. I would say it has probably the best chance at recovery. Overall, it'll probably recover the quickest, just because, again, it's pure tech, it's rocket fuel in the good times, it's an anchor in the not so great times. It's kind of how I've referred to HTAE. So in my RSP, I don't really need anything else. I'm just gonna let HTA do its thing. It's kind of my ride or die fund in my RSP. Again, I couldn't just get rid of it. That's how much I like this fund, and especially the people behind the HTA is a stock selection kind of fund. It's not just invested in an index. It basically takes the NASDAQ 100 and then squishes it down to just the purest of pure tech funds in there, right? 20 companies stock picked. Harvest has done a good job with this. Its price return since inception, which is like 2 years ago, is something like 70%. It's mind-boggling. So again, in this particular account, investing for a higher price appreciation, I still get a 10% yield. So therefore, if things draw down, I can still, basically reinvest, buy the dip every single month. I think in this account, HTA makes total sense. I don't need anything else in there. All I want in this account is just pedal to the metal, and I'm going to get that with HTAE. Where, as in my TFSA, it's an all-weather approach. I'm invested in a lot of all-in-ones. The reason why I even had HTAE in here in the first place was, to add a little bit of extra growth, rocket fuel, to this account. Now, we'll see how QQQY does, but I'm certainly not going to get the same level of price appreciation, and that's okay. That's what I want, and I'm really happy that there is a fund out there similar to HTAE that I could place in here, put some extra unrealized gains to use, right? That $5,000. And so basically that account is now set. And then of course there's the spousal account, which is it's just kind of plugging along. I'm not going to touch it. HYLD.U. I've probably actually done really what's actually helped this out as well. Not just the fact that HYLD has done well, the stock selection from Hamilton has done well, but also the currency conversion, right? Because this is in US dollars. I've also benefited from that as well, since I bought this back in August of 2023. Okay, so that is pretty well it for the return for those kinds of changes. Right, selling off HTAE in my TFSA and then buying it back in my RSP. That's really the big move, and then of course buying QQQY. So now let's look at my actual portfolio. Once we put all the numbers together, what does it all exactly look like? Now, if you want to view this for yourself, or if you want access to just a whole heap of information about CoveredCall ETFs, it's available on my Patreon, which you can access pretty much in every video or the main screen here. And anyway, there's a free sample up here, but then if you want the real meal deal, you just access it from here. But anyway, tons of links in all the videos. You shouldn't have any trouble finding a pathway to my Patreon. So one thing I like that I've now started showing, because I was asked of this by a Patreon member, hey, can you show your portfolio so we can track it? What I like about building something like this out for the community is that what's kind of fun to see is if you were to buy my whole portfolio today, this is the kind of yield you're looking at, which would be basically an average yield of 11.2%, but currently, albeit my yield is much higher. This is just, it's automatically like making it all equal, but it's not the case. 12.3%. I would say it's going to be a lot higher than that. I would say probably closer to 13. One thing I wanted to show you all here was just what I meant by like the capital gains. HYLD.U, $14,600 that are really doing nothing. Man, HYLD.U has just been such a stellar fund. It's a short-term play. I'll just keep it as is. That's totally fine. And especially too, the distributions have raised significantly this year on the HYLD and HDIV funds as well. Something I am thinking about doing, albeit it won't be anytime soon, is potentially adding a margin account where I can, say, borrow against my funds and have a little bit extra playing out in the background. Would it be a 1-to-1 ratio? No. Would it be a 1-to-2 ratio? No. If anything, I'd probably take on the modest leverage approach, which is like 25%. So that's something I've been thinking about. And as time goes on, like who knows if I actually do it, but it is something I'm considering, and I know the whole borrowing money against your covered call is definitely certainly a big topic of conversation, especially in those other two videos that I made about borrowing money for ETFs and then income yield versus income growth portfolios. So let's discuss how much income generation with these moves that I made, what does it actually change? So to first understand where I've been, let's look at this chart that I put out in the community tab every month. It is my income report post that I put out every single month. So you can see at the start of the year, now usually I do it 1 year out, not like year to date. But in this case, I guess I accidentally set the parameters for year to date. So either way, started January to, I guess, a little over 1,500. As of November, that is up to $2,147. So with the move of selling off HTAE, putting $5,000 of unrealized gains to work, getting a much higher yielder in QQQY, buying back HTAE in the RSP. What I am expected to earn as projected dividends in December is, if you can't see it, $2,000 $259. That is a $112 increase for income. That is a significant increase just from moving a couple of things around to put those unrealized gains to work and to pick up a much higher yielding fund. It just goes to show, stay educated on this stuff. Don't stay stale or stagnant when it comes to your income investments. Don't be convinced that your portfolio is the best. There's always something you could maybe tweak and learn. I don't think it's always about just messing with your portfolio just for the sake of it. All I can say is this: you get new information. Does it enhance your portfolio, or is the move you're making out of fear? Fear of whatever the markets are doing, or is it going to be the fear of missing out? Right. So if it enhances your goals, you make the changes, and there really shouldn't be any kind of emotions attached to this. In my case, yes, like I said, I like HTA a lot. I wanted to put it to work somewhere else. I had that opportunity, so it was a win-win-win across the board. I feel nothing as far as like worried about this move whatsoever. There is no fear. There is none of that stuff. It is just, it's a tactical move. It increases income, and it will continue to increase income over time. I still get my balanced approach of, right, ideally seeing these funds naturally grow over time. I don't have any worries that QQQY won't do that. It's just, again, it's just offsetting how I get my distribution. All these funds are geared towards a bit of capital appreciation with how they're set up. Now that we've looked at the income generation from those moves that I've made, I want to turn our attention to what a future non-registered account is going to look like. I'll get back into USCL, which I ended up selling off to get in the summertime, I want to say July, to get into EQCL. EQCL had raised its distributions. It had also, and now encompasses full covered call coverage across all of its funds inside of it. To my surprise, though, I've been waiting for a distribution raise. I think for us EQCL holders, we're still waiting for that. We thought with the changes bringing in 40% more covered call coverage, we would get that. Now, I'm still expecting that, even though it's many months later, but I suspect maybe there might be they need to see higher growth maybe on the emerging markets funds and the developed markets funds potentially. But nonetheless, I had always been fascinated with EQCL, and it finally gave me a reason to jump into it. EQCL, half of it is really just USCL anyway. So yeah, I get a little bit more coverage in different countries, even if they don't necessarily do as well. I just like having that exposure, and especially with all-in-ones, what I really like about them, as the fund managers come out with new products, they'll start to fill in the all-in-ones with these newer funds. So for example, EQCL, Global X just added, what is that, RSCC, right? Basically, I can't believe I never thought of this before, but it's the first Russell 2000 index here in Canada. And so they added it to EQCL. So immediately I get exposure to it. I don't really have a reason to invest in that kind of fund by Global X just by itself, but to get exposure to it in a light way, great, I'm all for it. Even like a fund like BMAX, it has a little bit of fixed income, and you guys know I don't really like fixed income, but you know what? If it's at a small scale in an all-in-one, yeah, I'm okay with that. That's fine. I mean, if it made significant changes where it really outweighs the equities inside of it, as BMAX is a multi-asset fund versus just an all-equity diversified across sectors. So I'm okay with that. EQCL is pretty much half of USCL anyway, but for the sake of driver growth, I also want to invest in QQCL, so I'll have the two indexes. That's probably going to be 50% of a non-registered account. Then I'll follow it up with some sector funds, higher yielders, which are really going to drive up that total yield. I think the average yield, I was looking at around 14%. Give it a little bit of growth with some more tax efficient, higher yielding funds, and I get 14.78% in there. So maybe I adjust those numbers a little bit. Maybe maybe I do a little slightly more QQCL and USCL, but again, going through this whole exercise, realizing what my TFSA is going to be for, kind of the all-weather approach, fund other accounts, solidifying a personal RSP, knowing that, like, look, I don't intend to use the money from my TFSA. I really don't want to. It's meant to reinvest. And I'm just coming to a place of, you know what, put that money to work elsewhere if possible. If it gives me a bit of a tax break, which it does, great. I still get to keep HTAE. So in my opinion, it's a win-win-win across the board. And again, going through this process has honestly solidified in my mind the kind of non-registered account that I want as well. With these 5 funds, I think in total I'll have about 13. Now, what I haven't figured out quite yet is if I get a margin account. By the way, this account would be under my wife's name, so we're going to try to take advantage of a much lower tax bracket. But for a margin account, I'd put it under my name, so I'd be able to write off the interest, and I'd get a much higher write-off with the interest payments if I was to do that. Now, if I did do that with the margin account, what I'd probably do is, instead of just investing lump sum, I'd probably dollar cost average that as well, because that whole account will most likely be starting from zero as I take money from the equity in my home, put it in a non-registered account under my wife. That is going completely to offset the cost of a rental. I've talked about HYLD.U. Once that money becomes available, that's going straight to offset the cost of a rental. So for a margin account, it really is going to be like, once all the registered accounts are maxed out and once all this money has been transferred from a house sale, with a margin account is really going to be like starting from scratch. So to just dollar cost average and take advantage of the little dips and the ups and downs in the market, that I'm totally okay with that. Again, I'm not committed to that, but it is an idea that is marinating. So with all that being said, hopefully you got something out of seeing all these different little changes to this portfolio. And hit all the buttons of likes and subscribe variety, and I'll see you all in the next video.